its private equity investments in the most recent fiscal year. It's an area that the average person has typically been left out of, but famed investor Michael Lee Chin is trying to change that. He spoke with Amber Kanwar about the principles he believes must be followed in order to create wealth and why he's giving retail investors access to private assets.
When I first started in business, I started off as a financial planner with Investors Group. And I would sit around the kitchen table with my prospects. And I would think to myself, Mike, what is the highest value added you can give to this family? And the answer came back very clear to me. Make them wealthy.
How?
So that was the question. Okay, so the question, and as a young man, aged 26, I thought to myself, is there a formula? No different from mixing 2 atoms of hydrogen with 1 atom of oxygen and you consistently get water. Is there such a formula to create wealth? So that was my quest as a young man. Because if there was such a formula, that is the first conversation I would have with my prospects, my clients, and more importantly, I would lead by example. So my quest was to find out if there was such a formula. So at the time we didn't have Google.
Yes.
We couldn't Google it. But today, out of interest, you should Google the formula for creating wealth and see what comes up.
And what is yours? Because the typical person puts amount in public stocks and public bonds and then just waits.
Yes. So what I did, I studied, I researched, and I observed. And I came to the conclusion that wealth is created by doing 5 things. Number 1, you own a few, not too many, high-quality businesses. Number 2, you really make sure you understand them. Number 3, you make sure they're domiciled in strong long-term growth industries. Number 4, you make sure they're using other people's money prudently. And lastly, number 5, you make sure that their businesses of the substance that you like to hold for the long run. So that's how wealth is created anywhere and everywhere in the world. Every wealthy person who has created wealth did so by applying those 5 principles consciously or unconsciously. So now I thought, if that is the case, the first thing I have to do is to make sure that I apply those principles personally, because the highest form of leadership is to lead by example, which I did. So having principles, they lead you. So as a young man, what I did, age 29, 30, I went out and borrowed $500,000 to invest in one stock, Mackenzie Financial Corporation.
So financial?
Financial at the time, because I understood it. It met all 5 criteria. It was in strong long-term growth industry. I understood it. It was a function of other people's money, and I had intended to hold it for the long run, which I did. So I bought Mackenzie in 1983, and I held it until we actually accumulated 35% of Mackenzie, and we are the ones who were the largest shareholder who eventually sold it to Investors Group. But more importantly, having defined the 5 tenets as to how wealth is created, that was the first conversation I would have with every single client. So having principles, they lead you to which road is relevant, and they also lead you to which roads are not relevant.
But let's get to the heart of what we're talking about. You know, people think they have no choice but to go to the stock market.
Yes.
And ever since 2012, you've set out on this new path of trying to offer retail investors access to institutional type products. What does that mean?
What does that mean? Well, having gone through the crisis, you know, it took the crisis to really jolt some sense into my head. And I recognize that having pride myself on leading by example and having clients, the crisis was in 2008 for 30 years. The crisis underscored one, dysfunctionality in how I was advising my clients and how clients are advised generally. And the dysfunctionality was, I got through the crisis less bruised because of my private assets, not my public assets.
So you're trying to give retail investors access to private assets?
Yes, of the highest quality that any institution, the most erudite, eminent institution would salivate over. So the quality has to be of that standard.
So you've been doing this since 2012. How has that business grown?
Well, coincidentally, the business has, we started, it's a new, because it's a new concept, private equity to retail investors, everybody's skeptical. So we have started, we have built and are building a distribution organization that is 100% subscribed to the principle of wealth is created by owning a portfolio of not only public securities, but also public and private, or private in addition to public, which is no different from CPP, which is no different from Ontario Teachers or Yale or Harvard Endowment Trust. So how has it worked? Well, we now need to get the products. The first product which is we brought to the marketplace was an issuance in an investment I made back in 2007. It's I co-founded the business with another Canadian entrepreneur, John Risley from Halifax, and we co-founded Columbus Communications. Anyway, this business back in 2007 had zero revenues. Today it has $500 million in revenues, zero cash flow. Today it has nearly $300 million in cash flow. We all got shares then at $1 per share in 2007. In 2009, in the middle of the crisis, we all got a dividend, 50 cents per share. In 2012, another pivotal moment for the company, the leading telecommunications investor in the world, his name is Mr. John Malone, bought 20% of our company for $3.08. We all got shares in 2007 for $1. So he bought shares at $3.08, and at the same time we gave our clients the opportunity to co-invest, same price as Mr. John Malone in Columbus. And it's coincidentally today as we speak, we closed that issuance in October of last year, less than 9 months ago. We just got bought out for $5, a 66% increase in the last 9 months.
So that's one issuance, but when you're taking this approach, what kind of returns can an investor expect that's over and above or that's different from the public markets only?
Well, there is a premium. Whenever you buy a private security, the private securities are valued invariably based on what public securities are trading for, and then a discount is added to the private situation because they're not liquid. But because of this discount, it means that the return, if you compare a private security to a public security, you can buy the private security less expensively. It means they're making a higher return.
Yep.
Right? So therefore, if being in the private market, you not only can negotiate what price you buy for, you not only can negotiate protective covenants, but you can also get a price that is invariably 30 or 40% less than you would in the public markets, and hence your rate of return will be more if your perspective is to hold for the long run.
When the financial crisis wiped out billions in wealth, not even legendary investor Michael Lee Chin was spared. He sold his business that was heavily invested in financials to Manulife to help stem the losses. But Lee Chin says it was his private equity assets that cushioned the blow. Today he's bringing those strategies to retail investors, and for a look at where he's finding these opportunities, here is part 2 of Amber Canwar's interview with Michael Lee Chin.
There are opportunities to create outsized wealth when 3 preconditions exist. The first is there must be a differential between perception and reality. Only when there's a difference between perception and reality can you create outsized wealth. First precondition. Second precondition is there must be dysfunctional inefficiencies, or better yet, dysfunctionalities. Because only when there are dysfunctionalities or inefficiencies do you have an opportunity to create outsized wealth. And thirdly, there must be a lack of equity capital going into the area or the country or the region. Because only when there is a lack of equity capital do you have an opportunity to create outsized wealth.
So give me some of those opportunities right now that meet that criteria.
Okay, so first, I can tell you what it is we're doing.
Great.
Right? we bought, having laid out those three tenets, not only guided us to owning the National Commercial Bank of Jamaica, not only guided us to building out Columbus Communications, which is we provide telecommunications services to every single Central American, South American country, Caribbean country bordering the Caribbean. It has also led us recently to buy a landfill site in Santo Domingo. So if you're in the Dominican Republic, and you're in Santo Domingo and there are 5 million people there, every day you pay us a toll because you produce garbage. And we not only collect a tipping fee from the municipality for accepting the garbage, but we also sell the recyclables, etc., etc.
It sounds like you're very active in emerging markets, which have seen some volatility in the public markets over the past couple of years. What is your view of the stability of the boom many people say is occurring in emerging markets?
You know, this is a very interesting question, Amber, because if you think about, and I'll use Bank of Nova Scotia as an example. Here it is, we sit back in the quiet comfort of or Canadian office or New York office, and we think these emerging markets are risky, right? They have political risk, they have interest rate risk, they have foreign currency risk, corruption risk, etc., etc. Risks are coming out of their yin yang. Yet still, if I were to say to you, Scotia Bank, Bank of Nova Scotia, 50% of their revenues are derived outside of Canada, primarily from emerging markets, and Scotiabank when Scotiabank first step out of Canada was to Jamaica in 1888, and Scotiabank is still in Jamaica, and Jamaica is still one of Scotiabank's highest margin subsidiary. So, and Scotiabank is very conscious of risks. So it's a different perspective when you are an operator on the ground versus when you are an investor in New York or Toronto. Right. So we take our cues by making decisions based on the reality of the situation, not the perception, which is tenet number one.
Exactly.
Right. So you'll find that generally speaking, the emerging markets, if you own a great business in those markets, you have less competition. You have less competition, and hence better margins. And you have better margins, it means you have less risk in your business.
You made much of your wealth from your investments in financials.
Yes.
Let's say you're 26 now, in 2014.
Yes.
Could you do today what you did back then in today's markets, given the bank scale, given what happened in 2008, 2009, given the central bank's involvements right now in the markets?
Yes, I am confident that we can. In fact, as you mentioned earlier, we have started our new business, Mandeville Group, which will give clients the opportunity to not only buy all the publicly traded securities that you can buy from any brokerage house, but also give them the opportunity to augment their portfolio with private equity, no different from CPP. So you have a portfolio that's a combination of public and private. So yes, it is replicable for the following reasons. Number one, most clients today, their focus is on creating wealth, but that there's a terrible job being done by the advisory community in terms of behaving in a way that is 100% congruent to how wealth is created, because no one has ever created wealth by owning a portfolio that is 100% public. Everybody who created wealth did so invariably by starting off with a private business and then eventually growing it and then eventually taking it public and ending up with a portfolio of private and public. So there's a dysfunctionality that we have recognized here, Amber. The dysfunctionality is every time you go to an advisor to get advice, you end up with a portfolio that's 100% public. But wealthy people, their portfolios are not 100% public.
Let's talk about those public assets, though.
Yes.
Much of it concentrated in a small basket of financials, Canadian financials. How stable are they right now relative to 2008, 2009? And what is the biggest risk that you see out there right now for owning financials?
Well, firstly, you see, if you were to do a census today, and you say to the average Canadian, tell me, what is the most conservative business you could own today? What do you think they would say?
Banks?
Exactly, the Royal Bank of Canada. But most people don't realize that a bank is a highly levered entity. In fact, the debt to equity loan to value ratio would be in the vicinity of 90%. Therefore, if assets went down by 10%, banks will be underwater, will go bankrupt. So it's a perception, right, that banks are conservative. But if you think about them from the standpoint of the leverage that are implicit in banks, it will be a different perspective. So what do we see today as where the values are? Well, if you think about it, energy, the price of oil, as an example, came down from $150 5 or 6 years ago. It bottomed out at $60 in the middle of the crisis. It bounced back to $100. And it's been bouncing around $100 for the last 5 years. As we know, up until this year, it was very difficult for energy companies to have gotten financing. There was a lack of equity flowing into that area. And remember, I mentioned 3 tenets. There has to be perception versus reality. There has to be inefficiencies, and there has to be a lack of equity capital. So wherever there's a lack of equity capital going in, which energy up until the beginning of this year, they had a tough time raising money in that sector. So we're very bullish on oil and energy. And the fact that a lot of these businesses, they give a dividend yield of 6%. You're being paid while you wait. And the macroeconomic situation is perfect because Ms. Yellen, Janet Yellen, has said they will, the economy will, the QE2 will be removed once the economy is on its own 2 feet and inflation has come back. Inflation coming back mean energy price would have gone up. Therefore, would have made, if those who buy energy now would have had a tremendous capital gain and being paid while they wait. Because these energy companies, Baytex, Crescent Point Energy, Canadian Oil Sands, they're yielding over 6%.
Yeah.
At these at $100 per barrel. So they're very profitable at 100. How about at 101, 102, 105?
That was Michael Lee Chin, Executive Chairman, CEO, and CIO of Portland Investment Capital.